Hello, this is Matthew Copley, President and CEO of Copley Financial Group. And today we're going to do a market update, talk about some of the new economic data we're seeing, some of the risks that we're seeing in the economic numbers. We're going to talk about Social Security and the cost of living increase that is expected in January. And we're going to dive into some potential real risks of a recession and what to look out for in the market. Also going to cover the new MYGA interest rates, what we're seeing as far as guaranteed rates, which have dropped just a little bit, but we still have some really good rates there. And also the buffered index and the new cap rates, all coming right now in this video. So the economic data is very mixed. We see some good signs, healthy signs that things are potentially recovering in some areas of the economy, but we're also seeing some real risks start to develop. And those risks involve artificial intelligence. We are just seeing such a large amount of capital going into AI. We're seeing the numbers are just eye-popping. As far as 8% of the entire S&P 500 stock market is now just one company. NVIDIA now represents a massive share of the stock market. And there's a lot of concern around these companies. You've got all of this revenue that's coming in from, for example, OpenAI and some of these AI companies. But at the same time, what's happening is NVIDIA and Oracle and these companies are actually putting money into OpenAI so OpenAI can buy their products. So it's this big circle that we saw a little bit back in 1999 and when the dot-com bubble was happening. We saw some of this companies investing in a company to buy their product kind of stuff. This is where you see a lot of stuff happening at tops in the market. And when we see current valuations on some of these AI companies, I start to get a little nervous on what potentially the market looks like going forward. And of course, the big concern with AI is how are they going to make a profit? How are they going to monetize their business? And at this point, I've looked into it. I don't know how they're going to make money. It's costing them a lot more money to do these AI queries than they're generating an actual revenue. So right now, everything's being subsidized. So we're a little bit concerned regarding the AI story. I do think AI is a real thing. I think it's going to be a big deal. It's going to revolutionize a lot of industries, a lot of businesses. But how do they make money? And we're starting to see not just AI, but other areas of the economy that are starting to have a little bit of issues. Obviously with AI, we've got, for example, Facebook recently announced a big layoff with AI, their AI division. But we also have retail. Target just announced 8% of their workforce in their corporate division there is being laid off. And so retail is a potential issue. And so we're starting to see a lot of these companies that have these high valuations like Target and Walmart and Costco may be at risk if we start to see retail start to come down. So looking overall at the economic data, it's very mixed. There's some good stuff, there's some bad stuff, but there's some really big potential issues with AI that we're watching very, very closely. And of course, we'll want to take actions if we see anything that we might want to do because of any big changes in that industry. Another big concern is what's going on with recent corporate bankruptcies and failures. We've seen the regional banks really come under pressure recently. And this is a company that was involved in the car business, car parts business, that was massively indebted. And one of the regional banks, Jefferies, actually valued them at $6 billion, and a month later, they're basically bankrupt. So something is happening, very loose lending standards that we're seeing within that space. And speaking of the car industry, we're just not seeing a whole lot of profits. For example, Tesla, I mean, they peaked profit in 2022. Their profit has been going down and down and down. Even the most recent Tesla report that just came out, earnings report, was negative, less than expected. On the top end, they look good as far as some of the revenues, but earnings are just not looking good. And it's not just Tesla. Rivian just laid off a bunch of people. And so these EV companies are not doing so hot in the car market. So that's something we're certainly looking at, watching. What do you think about EV cars and whether this is going to be the future? Put some comments below on what you think you see Tesla doing in the future. I'm interested in really diving into what it looks like for these companies. Obviously, electric vehicles is something that I personally bought an electric vehicle. My wife's driving it, and it's a great vehicle. We love that car, but is it really viable economically? What kind of subsidies were there? I got some big tax rebates when I bought mine before all the credits disappeared. So what does it look like going forward? Let us know what you think in the comments. We're seeing a lot of good economic data coming out of traditional type businesses, and one area that I think is at real risk, and this could trigger a major problem in the markets, is cryptocurrency. And one of the big concerns that I have is what I believe is a real scam going on with MicroStrategies. This is a company that is taking investor money in and buying Bitcoin. But what they're doing is they're actually offering two different types of investments. They're offering what's called preferred stock, and they're offering what's called common stock. Now, the preferred stockholders get an 8% preferred dividend yield. Well, the problem with buying Bitcoin and paying an 8% dividend yield is Bitcoin doesn't pay a dividend. So the only way that that dividend can be paid is if they issue more shares of common stock in order to pay the preferred shareholders. This is called a pyramid scheme. And so this is a real concern. If you're bringing money in and you're having to pay out a preferred yield on new money that you bring in, that's a real risk. And the big concern that we have is what happens if MicroStrategies has to start selling Bitcoin because for whatever reason the price comes down, people stop investing, they pull money back. Then what happens? The Bitcoin price starts dropping, but then they have to sell Bitcoin because the price is dropping, and then it becomes a big problem. And unfortunately, it's not just MicroStrategies. We're actually seeing other companies doing the same thing, copycat companies that see what MicroStrategies are doing, and they're doing the same kind of thing. They're issuing shares in order to buy more Bitcoin. And the concern is how much of the demand for Bitcoin is being generated by these companies like MicroStrategies. And this is where there could be a major meltdown. And if you see a big drop in something like cryptocurrency, which has been a real popular thing, especially among younger people in this country, this could trigger a bigger sell-off across the board in all types of risk assets. And we've seen this where cryptocurrency has actually been going up along with all the tech companies and some of the NASDAQ and these kind of companies. And when the NASDAQ and the tech companies start to come down, all of a sudden Bitcoin is dropping. So there is some kind of a correlation between these two when you look at it on the charts. And so this is one concern that I'm watching. I'm watching the cryptocurrency, and it's something that if you start to see big drops in that market, what happens internally at MicroStrategies and these other companies, that's yet to be seen, but it is something we're watching very closely for a potential catalyst of a big drop in the overall investment markets. Now, where are we seeing the strength? Obviously, your accounts are way up, everything looks great. Where is that coming from if we're having a lot of challenges in these other areas? And a lot of that strength is coming from value stocks and gold. So the value stocks are companies that have traditional high free cash flow models, good dividend yields. We love the companies that produce things that we need like food and energy, but gold has been the real shining star. The price of gold has just shot up since August, and we recently had a big day that drop, about 6% drop in gold prices in one day, record drop. And everyone's talking about this major crash in gold, and this big deal. I've seen all these headlines, and to me it's kind of silly. So instead of being up 56% this year, we're only up 50%. I mean, it's the amount of gain that we've made on gold just really since August. I mean, this recent downturn is such a small number. Now, what's been driving this huge surge in gold price? By the way, as I'm doing this, the price of gold is $4,120 an ounce. Massive number. I mean, we just broke 4,000 not too long ago, and got all the way up almost to 4,400. Now it's back down to 4,120. So why is the gold price going up so much Why has it moved up so much this year? Well, a lot of it is central bank and institutional buying across the board. You're seeing a lot of de-risking when it comes to U.S. Treasuries. So central banks around the world, the Bank of China, the Bank of India, the Bank of Russia, all these different banks, what they're doing is they want to get rid of U.S. dollars and they want to own gold. And it's not just those companies or countries I mentioned, like the BRICS, but it's also some of our allied countries. They are also accumulating gold. And so when you're looking at how much gold is being held on the balance sheets of these central banks, we now have almost as much gold reserve being held as we do U.S. Treasuries. This has not happened in a very long time. And so there's a lot of demand by banks, by institutions for gold, which has driven up the price. Now, obviously, the concern is when you see a hockey stick graph where the price goes straight up, obviously there's going to be some sharp reversals. And you typically see this in markets that are in what's called a bull market, where the market's going up. The biggest drops you see are within a very strong market. So you see the markets going up, big drop. Markets go up even higher, big drop. Markets go up even higher. This is the opposite in a bear market. Typically, when the markets are going down, you see the markets like a slow grind, torture down, and then big spike up. And then slow grind, torture down even further, then big spike up. So the big spikes actually happen in bad markets. The big drops happen in good markets. So a big drop like we've seen in gold recently is actually, I think, a positive sign. You've seen a shakeout of a lot of weaker positions, which will allow for the next run up. Now, is the drop going to just end here, or will it keep going? There's a good chance it will continue to go down further. If it goes down to the 21-day moving average, that puts us at about 39.50 on gold. I would expect that. That would be a reasonable spot where we would see gold prices start to settle, and we have a little bit of a floor, and we start to take off from there. It could potentially get down to the 50-day moving average, which takes us down to about 3,675. That would be a big drop from here. And obviously that would be a big drop in some of the accounts that we have because we have larger gold positions. Now, is that possible? Yes, it's possible. I don't expect it to get that low, but it could go down to that level. But I don't think it would stay there for very long. I think you'd see gold prices. In fact, I'm targeting $5,000 an ounce next year for gold in 2026. I think we're going to get there, and it's not going to be a straight line up. We're going to see these big reversals that come down, and it's going to continue to trend up. Now, why do I think this is going to happen? Well, gold is severely under-owned by the retail public. All these central banks, all these institutions are buying gold, yet the average investor hasn't figured this out yet. In fact, 0.5% of people's investments are in gold at this point. 0.5%. Now, traditionally, it's been about 2% if you go back through history, but right now, gold is severely under-owned by investors. Current people that have investment accounts, they don't own gold. And we're starting to see some mention of this. In fact, recently, the CFO of Morgan Stanley came out with a report, and he recommended that we switch from a 60-40 portfolio, which is 60% stock and 40% bonds, to a 60-20-20 portfolio. What is that? Well, that is 60% stock, 20% fixed income bonds, and 20% gold. Now, this is really ridiculous. I mean, if just the people at Morgan Stanley sold off half of their fixed income positions and bought gold, you would need all the gold in Fort Knox just to have those people. I mean, just the people at Morgan Stanley. The idea of 20% gold ownership, I mean, the price of gold would be $50,000, $100,000 an ounce. It'd be outrageous. There's no way that I expect that kind of percentage. But it's interesting because our current positions in the Copley Tactical Fund, which is up 26% this year, way beating a lot of the benchmarks, we have a 22% position in gold, right? So we do have that position that Morgan Stanley is now recommending, but that's because we feel like this is a really good catalyst to get some good returns going forward. Now, is the price going to be straight up? No, going to be a lot of volatility. Expect that volatility within the markets. We could see some more drawdown before the next run up, but I think gold is here to stay. I think it's going to be a real safe haven. And if we just get to the 2%, not 20, just to the 2%, I mean, that's a 3 or 4-fold increase in the amount of gold that people own. And when you start seeing that kind of accumulation among the retail public, you're going to see gold prices really move higher. And we want to make sure that we're positioned in front of that move. And that's why we're going to hang on to those gold positions. I think gold is a great investment. And we've seen now the price of gold kind of dip down over the last day. Well, you know what? Good opportunity to maybe start accumulating more. We are looking at the gold mining stocks, which is primarily what we're investing in, because it's such a bargain right now with the current price of gold. And the reason this is such a good deal is the gold mining companies, they own the gold, but they own it in the ground. And they actually can pull that up out of the ground and make a profit. So not only do you own a bunch of gold, which is sitting in the ground that you get to mine and sell, but you actually get a profit on the difference between what it costs to mine and what it costs to sell. Where if you just own gold, if you just have the physical gold, you only get the increase in the gold price. So that's why we're focused on the gold mining stocks, which I think is a much better opportunity for speculation on the increase in the gold price. And so that's what's going on. That's what's driving a lot of the big gains in our accounts this year. And so yes, expect the volatility like we recently had, but we are going to see some big results going forward in gold prices. And again, $5,000 next year is my expectation. Now, speaking of gold, one of the reasons that people own gold and hold gold is as a inflation protection hedge against the US dollar, against dollar debasement. And so one of the things that we are interested in, especially for our clients that are retired and collecting Social Security, is how much is my Social Security going to increase next year? Well, we actually should get the official numbers tomorrow, even though the government is still shut down and we are not getting a lot of data from the government. We are being told that we will get the inflation numbers for Social Security and the COLA, the cost of living adjustment, tomorrow. So look out for that. It'll probably be articles all over the media on that number. The expectation that everyone is saying is 2.7%. That is the expected increase that we are going to get in January on all of our Social Security checks. This will be money that's coming in for people that are already collecting. And it'll also increase people that have not started collecting yet. It'll bump all of your numbers as well. And so look out for that Social Security increase. And of course, as far as the investments that we are really liking right now, recommending, obviously we love our tactical fund. Alpine Capital has just done a tremendous job this year with the value stocks. A lot of the gradient investments have done well. So we're very happy with a lot of the stock accounts. However, the buffered index is a real standout. This is an investment where you get to go up with the S&P 500 up to a cap, and you have this big insurance policy in case the market goes against you. And because you get the opposite return on the way down, this could be extremely valuable if we have a downturn in the stock market. And we do have another we've been very excited about. And it actually went away for a while because we couldn't get good pricing in the market. But we recently got a very good pricing on this. It's 185% participation rate with the S&P 500 Futures Index, which means that over the next 5 years, whatever that S&P 500 index does, you actually get 185% of the index return, which is a big deal. If the market goes up 50% over the next 5 years, you're going to be up 92%. If the market's up 100% over the next 5 years, you're going to be up 185%. This is a very good product to beat the S&P 500. Now, of course, the drawback on this is you got to lock your money up for 5 years. So that being said, we love it for long-term growth, money that you don't need for the next 5 years. If you're looking for more of the shorter duration, you want the protection. If the market goes down, you want that opposite return, then the 2 years probably a better option on the buffered index. Finally, the fixed interest rates, we're going to get to those. This is the guaranteed insured interest that you can get. It has come down a little bit. We've been up at that 5.75 level for both the 3-year and the 5-year for a very, very long time. And we recently had a reduction. We actually moved to another insurance company that is offering now the highest rates. And so we have a 3-year at 5.42%, and we have a 5-year at 5.62%. And so those are the rates that are available on the insured side. Again, 5.42 on a 3-year, 5.62% on a 5-year. And this does offer a 10% penalty-free withdrawal every year during the term. So there is some liquidity on this investment. It's essentially like a CD with an insurance company, fully insured, interest rate. And so this is a great product for someone that says, I just don't want any risk. I want guaranteed interest. Now, not quite as good as the 5.75 we had, but you know what? 5.42 or 5.62, pretty good interest rate. And so the reason that I like this and I look at this is, you know, what if we're in a situation where the stock market does come down? Well, you got the buffered index that's going to get the opposite return. You've got the MYGA that's guaranteed to pay interest. So if some of the other accounts that are directly participating in market investments are down, well, this may offset it and we may not take too bad of a hit. Well, what if the market continues to go up? What if we get 10, 12, 15% returns in the market? Great. Well, you're still getting 5.42 or 5.62. It's a decent rate. It's a heck of a lot better than you can get out of a bank today. So we really do think it's a smart product. And I am concerned that interest rates will continue to come down further. Normally, when you see this kind of peak and it kind of plateaus, and then you start to see rates start to drop, normally that usually results in a cycle where the rates continue to drop and continue to drop, just like they did on the way up. And so if you are interested at this, in these interest rates, you should probably lock these in sooner rather than later. Reach out to one of our advisors here in the office, and we can certainly get this interest rate locked in. There is no guarantee when these things are going to come down, and it's usually pretty quick. We get an announcement, they cut the rate, and there's not much time to do anything. So definitely reach out if you're interested in guaranteed interest that is going to beat a lot of what you see out there in the bank CDs and savings accounts and money markets. Well, I hope that was a good market update and you got some good information there. I think now is a really good time to kind of dial in and look at the different accounts. When we start to see some shifts and changes in the economy, it is a good time to kind of review everything. Just reach out to one of our advisors here in the office. You can simply email support@copleyfg.com, or you can call the office and talk to someone, and we can really dive into what we talked about today in this video and really get you in a position where I think that you'll be happy protecting yourself now more than ever. Create those hedges. You know, we're not going to continue to probably get these kind of returns that we've been getting. You know, don't expect 26% return on the Copley Tactical Fund. Don't expect these kind of big results that we've gotten recently, because I do think things are getting a bit overvalued. And so we want to really dial back some of the risk and really look at opportunities to protect and hedge accounts after these big returns. So thank you all for watching. I hope to see you in our office very soon.